Welcome to this week's Bitcoin report on the Brooks Trading Course YouTube channel, analyzed by trader Josep Capo. We'll explore Bitcoin's weekly and daily charts with clear, precise insights. The analysis has been written after Friday's September 19th U.S. stock market close. As always, we are going to begin with the weekly chart. Before jumping into the current price action, let's review the key structural points we've been tracking. Last year, Bitcoin had a bull breakout above an 8-month trading range. That breakout hit a measured move target based on the height of that trading range. We flagged early that this measured move resistance aligned with the psychological resistance at $100,000, which is always a magnet for profit-taking and a natural ceiling. We said this would trigger caution, and indeed, many traders locked in profits. That led to sideways price action, which we read as distribution. The market then printed a double top, and that double top broke down. The breakout bar to the downside was a strong bear breakout bar, though technically an inside bar. At that point, after that kind of size and momentum on the bear bar, the market transitioned to always in short. However, we cautioned about strong supports in that area. Specifically, we had the previous higher high breakout point, which often acts as a key demand zone. Also, despite the size of the bear breakout, the bar had tails, which hinted at buying pressure and absorption. That kind of price action, bear breakouts with bad follow-through, often means bear conviction is weak. So, even though the move looked strong on the surface, we were not fully convinced it was a true breakdown. Aggressive bulls stepped in during the pullback. The high one signal was technically there, but it was a bear doji in a poor context, not a high probability buy. Then came the high two. But this followed a bear surprise bar, so we expected at least a second leg sideways to down. That was the price action logic. Then the high three triggered, and this time we noted it was a legitimate entry. Why? We had support from the previous higher high breakout point. The 365-day moving average, not shown on this chart, was nearby. The signal bar was a good bull bar with a clear body. The entry was low probability but came with a great risk-reward profile, which is an important trader's equation. That high three trade led to a bull swing. The market shifted to always in long status during the formation of the 5th consecutive bull bar. Classic bull trend behavior. Trend resumes after a pullback fails to reverse. This was textbook price action. Bulls then printed new all-time highs and created an 8-bar bull microchannel, which is a sign of sustained strength. What's more, they reached those highs before bears could close the gap left from the previous higher high breakout. That's a strong technical signal in favor of the bulls. This price action structure formed what some would label a cup and handle pattern. The formation itself is not important. What matters is the underlying price action logic. After a resumption of a bull trend, first pullbacks are usually high probability buys. The bull breakout from the handle was essentially the signal. Even if follow-through is uncertain, the setup offers positive skew, good distance potential, with relatively low risk. If traders raise their targets, the win rate will decrease. That's the trade-off. But the setup remains a favorable trader's equation on higher timeframes. What followed wasn't the ideal outcome for bulls. The bull breakout had bad follow-through, which typically leads to sideways movement. We called this in real time. Still, the market continued to print higher highs and higher lows, which technically defines a trend. Bulls probably stayed in, at least partially, especially those who entered lower. But when the market reversed down from the highs, forming a bear reversal bar, and then broke the bull trend line, things changed. That price action forced breakout bulls to either move, stops to break even, or exit. The market printed 3 consecutive bear bars, and eventually closed the bull gap between price and the previous higher high. That was a bad development for the bulls. Now we find ourselves in a zone where predictability is lower. The market has been sideways for over 10 weeks. Early October might bring quarterly flows, which could be a catalyst. But sideways action often reflects balanced forces between bulls and bears. No clear side is in control. In these conditions, the best strategy is to stay on the sidelines and wait for clearer information. What should traders wait for? For bulls, the cleanest opportunity would come from a retest of the major higher low. That area is technically interesting. There are bull micro gaps still unfilled. The lower trend line of the major bull channel also runs through that region. A reversal up from that level would be a clear stop entry trade setup. Buying a bull breakout from current levels would be a third leg up, and the bull trend has already closed its bull gap, which is a weaker backdrop. That makes it harder to justify buying strength at this point. For bears, the situation is different. It's not attractive to sell down here, because price is near key support zones. But a reversal down from above all-time highs would be a cleaner and safer sell. That would give bears enough room for a measured move and reduce the risk of getting trapped in a bull continuation. Right now, the market is waiting for clarity. Bulls need a clean pullback with support reaction to re-enter. Bears need price to reach new highs and stall to justify shorts. Until then, it's a low probability zone for both sides. The daily chart remains confined within a well-defined trading range, with price action oscillating between 120,000 and 110,000. This range represents a battleground where neither buyers nor sellers can establish dominance. Gray rejection zones on the chart highlight areas where price was swiftly repelled. These zones serve as clear boundaries, reinforcing the upper and lower limits of the trading range. The market's range-bound behavior is unmistakable. Breakouts repeatedly fail to sustain momentum, frustrating traders seeking directional trends. Following strong bull bars, the market often produces a bear bar or doji, signaling hesitation or immediate selling pressure that halts bullish advances. Similarly, strong bear bars are typically countered by bull bars or indecision candles, maintaining the market's equilibrium within the range. Scalpers excel in this environment, capitalizing on predictable reversals. They buy strong bear bars near the range's lower boundary and sell strong bull bars at the upper boundary. Scalpers target quick profits and are prepared to scale into positions if the market moves against them, confident that price will eventually revert to their entry levels. This strategy carries significant risk, with a high potential for substantial losses. Only traders with sizable accounts and the ability to trade small positions relative to their capital can execute it effectively. Most traders prefer safer approaches, focusing on buy reversals near the range's lower extreme and sell reversals near the upper extreme, aligning with the market's tendency to respect these levels. A hallmark of trading ranges is the alternation between bull and bear legs. A bull leg is typically followed by a bear leg, and a bear leg sets the stage for a bull leg. The most recent price action reflects this pattern, transitioning from a bear leg to a bull leg, consistent with the range's cyclical nature. In our prior analysis, we noted that bears were unlikely to drive prices significantly lower, anticipating a bull leg based on the chart's structure and dynamics. This outlook was supported by bulls closing bear body gaps from previous lower lows, indicating increasing buyer strength and a shift in momentum. Identifying precise bull entries at the range's bottom proved challenging. The lack of clear setups led to no actionable trade recommendations. Price then consolidated into a triangle pattern, a common precursor to breakouts, reflecting tightening market tension. A bull breakout followed, with solid initial follow-through, shifting the market into an always-in-long phase, where buyers held control. Another bull bar reinforced this move, but a pullback soon emerged. Buying the first pullback after a breakout is generally a high-probability trade in a context like this. Most of the time, swing trades produce modest outcomes, resulting in either a small profit or a small loss. Traders who entered on the follow-through bar likely exited at break-even. A bear bar closed below the bull body gap. This reversal occurred at a resistance level, the wedge bottom high, a logical target for bulls who entered at the lower end of the range, prompting profit-taking. The market now sits near the midpoint of the trading range, a neutral zone where neither bulls nor bears have a clear advantage, creating uncertainty about the next move. Bulls maintain a slight edge as long as bearish gaps remain unclosed. Open bull gaps signal underlying buyer strength, suggesting continued support. Recent price action differs slightly from earlier patterns on the left side of the chart, hinting at a potential transition to a new market cycle. Price may consolidate further, possibly forming another breakout pattern like a triangle, given its position near the range's midpoint. Alternatively, it could continue oscillating, creating reversal opportunities at the range's extremes. Breakout trades carry elevated risk at this stage. Waiting until October, when institutional flows stabilize post-third quarter close, may offer clearer opportunities. September marks the end of the third quarter, a period often influenced by institutional rebalancing. October's price action will provide insight into how these flows shape the market's next move. Thanks for watching. Hit that like button and subscribe for more weekly Bitcoin updates, and check out brookstradingcourse.com for more insights. See you next time.